Hey guys, welcome back to the Trading Coach Podcast. In today's episode, we're going to talk about backtesting, we're going to talk about changing market conditions, and we're going to talk about choosing what time duration you should be trading on. If this is your first time joining, my name is Akil Stokes, former struggling trader turned successful trader money manager. I am now a trading coach and co-founder of Tier1Trading.com, one of the leaders in trading education out there. If you're interested in joining our platform, checking out our educational services, you can do so. Just head over to www.Tier1Trading.com. Now, I got a question on social media today, and as always, I like taking these questions. I love that you guys ask them, and I like turning them into Trading Coach Podcast episodes because I know if one person has this question, there's a good chance at least one other person out there has it as well, and this can be a helpful hint or tip. And the trader says, Akil, compliments of the season. I have a question. Since different market environments exist, then it may be okay to backtest based on information of what time a very volatile market plays or a slow market is running. Backtesting a strategy of 10 or more years at a stretch may not define the market environment. And so it's possible a strategy can fail for 4 to 6 months and then resume successfully after months if a long-term trader given years. The question's a little bit miswritten, but I'm trying to basically a market can change throughout the years. So I'm thinking it's better to backtest, say, a strategy that will be executed on a lower time frame, say 1 hour to 15 minutes, for a short duration like 4 months or 1 to 2 years, rather than to test 10 to 20 years, etc. What is your opinion? How long do you recommend backtesting? How long do you recommend going back into historical data and some other stuff? Like, it's kind of, again, the English is a little bit off. But essentially the question that this trader is asking is, because market conditions change, is it worth it? Is it valuable to test over a long period of time, knowing that conditions may change every 4 to 6 months or may last years? Or is it better to go down to a lower time frame and test that way? That way you don't have to deal with kind of these long stretches of back and forth nature. And there are many layers of this question that I addressed in my answer. I'm going to hopefully remember all of them so I can give them to you as well. But first and foremost, we need to ask ourselves the question, why are we picking the trading time frames that we're picking? And in this case, I think the trader has it backwards, right? We shouldn't be picking what time frames we want to trade based off what we want to do backtesting. We should be basing the time frames that we want to trade off of based off our lifestyle, based off our personality. Again, the number one thing that we want to do in trading is, right, we want to create our trading around what we ultimately want to do in life, right? If you are someone that, you want freedom of time, you don't want to be a slave to your chart 5 hours a day, then it's going to be a bad idea to kind of try to be a day trader where you're spending multiple hours in front of your chart in a kind of an active trading environment. If you're someone that doesn't want to give up your job, maybe you don't care about being full-time, you just want to use trading as supplemental income, and you have a 9 to 5 and you can't be active at your chart, you probably want to adapt more of a swing trading type of style. Maybe you have a time to check it once or twice a day during a break or something like that. A swing trading is going to be a much better option than a day trader. If you're someone that, and I'm personally doing this right now in my trading career, I'm trying to add what I hopefully believe is the final piece of the puzzle to buy me more time throughout the day, is a end of day strategy where I literally only have to check the charts once a day. So it opens up a whole bunch of free time during the rest of my day. And what I'm doing is, right, I've been backtesting strategies for years and years and years, and I found some that work in different ways, but I haven't used them because I'm focused on the one that works specifically in what I'm trying to achieve for my life right now. So we want to adapt or choose our strategy based off of the type of trader we want to be, and the type of trader we want to be should be based off of the lifestyle that we want to achieve. Now, with that being said, going back to the market conditions changing type of question, yes, market conditions change. They will always change, and they have always changed, and they will always change into the future. There's nothing we can do about. How are the markets going to be 5 years from now? I have no idea, right? Could I have guessed COVID? Could I have guessed a worldwide pandemic, right? No, right? We don't know. Historically, we know that there are ebbs and flows. There are rallies and crashes and rallies and crashes. And, although we can predict these crashes and we know that they're coming, every 8 to 12 years, somewhere in that range, we don't know how they're going to come. Even within the periods of rallies, right? There are going to be low volatility periods. There are going to be high volatility periods. And we don't know when they're going to come, right? The point of backtesting, why we always encourage backtesting over a long period of time, and you don't want to backtest for like 1 month and be like, oh yeah, worked in the first month, I'm good to go, is because we want to give ourselves the best opportunity of seeing how our strategy performed throughout different market conditions. And if you go 10 years back, there's a good chance that you're going to see different market conditions. And again, I'm not necessarily talking about rallies and crashes because especially if you're more of a trader than an investor, you're always going to have short-term rallies, short-term crashes, right? Extensions and pullbacks. The main thing is going to be more directional movement versus consolidative movement. That's the thing that's going to really affect your strategy, right? Directional movement is when the market is trending, whether it's up or whether it's down. The market is just going someplace, it's moving, because certain strategies are going to benefit in those type of market conditions. Certain strategies are going to get punished in those type of market conditions. Consolidative, right? Those type of market conditions are when the markets are going sideways. They're more range bound. They're going up and down, right? Again, certain type of strategies are going to get punished in those conditions, while other types of strategies are going to reap the benefits of those market conditions. And what we want to do as traders is we should know what type of market conditions benefit our strategy. If you are a trend trader, then directional market conditions are probably going to be good for you. Consolidative conditions are probably going to be poor for you, and vice versa. So in that backtesting process, what we want to make sure we're doing is we're testing over different periods, right? We test our strategy during periods of directional movement. We test our strategy during periods of consolidation to see how they perform during both. Can we weather the storm? One of the biggest things I see with trend continuation traders is they create this trend continuation strategy, and it works really, really good when the market is directional because you get these big wins and these massive profits. However, they get whipsawed and chopped to death during periods of consolidation because it's loss after loss after loss after loss after loss because the market never continues. To make matters worse, what many traders do is they start off during these directional periods. They see their market, or their strategy, I should say, is incredible. They don't feel like doing the rest of the testing because it's a waste of time. I just want to trade live and start making money. They trade live, they hit a period of consolidation, and boom, they're taken out the game. So I think if you test back, and again, this all depends on the time duration in which you're trading, right? If you're a daily chart trader, right, then you're going to need to go 5, 10, maybe 15 years back just to get enough big enough sample size in general. If you're someone that's trading a 5-minute chart, you don't necessarily need to go 10 years back, right? You'll probably have enough information in the last 2 or 3 years, right? Also, keep in mind, if you are someone that's doing a 5-minute chart, and this is very important, the data, there's nothing against tracking data across the 24-hour period if we're talking about Forex, right? But you also have to understand that you're not going to be actively trading those full 24 hours. So again, there's nothing wrong with having more data. It gives you clues, but you want to make sure your sample size is based off the time period that you're actually trading in. It's very easy to get 100 trades probably within a few months if you're a day trader, if you're going 24/7. However, if you know you're only going to be trading from 7:30 a.m. to an 11 o'clock a.m. and within that window, maybe you only get 2 trades a day, well, now you've got to go back more months, more years to get that big enough sample size. And I don't think I mentioned this, but typically, I think 100 trades per pair, per strategy is a good kind of starting point, at least a minimum you should have for your testing. So point of this podcast is to realize that it's not the solution to be like, hey, market conditions change, so I'm going to test a lower time frame period, because market conditions are fractals just like the market. You're going to have changing market conditions, bigger picture. You're going to have, from year to year, you're going to have changing market conditions, smaller picture from week to week, even day to day, depending on what the market is doing. So it's not a solution to say, hey, I'm afraid of these market conditions changing. I don't really trust it, so I'm going to go down to a lower time frame. You're simply going to run into the same issue. So instead of doing that, first, decide what or how you want trading to fit into your life. 2, Pick a strategy that allows trading to fit into your life the way you want it to. 3, backtest the appropriate way based on that strategy. Hope you guys found value out of the podcast. If you did, let me know. Show me some love. If you're watching on YouTube, hit that like button. Leave a comment below. If you're listening to this on the podcasting app and you haven't done so already, do me a favor, leave me a rating and a review. Of course, if you want some more education, if you're looking for coaching and mentorship, check out our website, www.tier1trading.com. I recommend the 14-day risk-free trial membership. That way you can try things out and make sure we're the right fit before making any type of financial commitment. That's www.tier1trading.com. See you over there.